Equity method journal entries. All right, well, I kind of give you a hint at this before. So these are the three main journal entries to account for our equity method investments. When we invest in the subsidiary, right? Investment in investee. You could call it investment in subsidiary. You could call it investment in Home Depot. All the same thing. You are going to debit that asset because now you have an investment, right? You bought a bunch of stock, so you debit an asset of investment in investee, and you credit cash because you paid cash for that. Then what about your share of earnings, right? This is going to record increase in investment by the share of earnings in the investee. All right. Well, no, pardon me, this should be the other way around. Investment in investee, and this should be cash. And then we have the other way around for dividends. So when you record an increase in investment by the investor's share of earnings, right, we've got, like we saw before, we're going to increase. So let's say you own 30%, they make $100,000 of net income. This is going to be a debit to investment investee of $30,000, credit to cash of $30,000. And journal entry to record the decrease in investment by the investor's share of cash dividends. It's just a return of capital here. Debit cash, credit investment in investee. If this was fair value method, we would debit cash and credit dividend revenue. Just a little bit different treatment here. Here's an example in which we are going to use our equity method. So on January 1st, year one, Parent Inc. acquired a 40% interest in subsidiary corporation for $600,000. At the date of acquisition, subsidiary corporation's equity, also known as net assets, right? Because assets minus liabilities equals equity, also known as net assets, had a book value of $1.1 million and a fair value of $1.2 million. The difference between the book value and the fair value relates to equipment being depreciated over a remaining useful life of 10 years. During year one, subsidiary corporation had net income of $180,000 and paid an $80,000 dividend. All right, a few tasks here. We got to prepare some journal entries, compute the fair value difference in goodwill, right? Because we've got a difference. We acquired a company, and generally when you acquire a company, you're going to revalue it. And you're going to assess, okay, does the fair value of the company reflect the book value? And we're going to calculate goodwill. We're going to take that into account and determine our investment amounts at the end, right after we take into account net income and dividend. So immediately we're going to get 40% of the net income, 40% of the dividend for the period that we were holding this. All right, well, like we saw before, here is our journal entries, right? This is literally the journal entries we just saw before. Well, what did we pay to acquire this? We paid $600,000. Cool. So we now have a debit to an asset of investment in subsidiary. We have a credit to an asset of cash. And that's just us buying our investment in it. Journal entry to recognize the investee's net income. So this is 40% of $180,000. Right, we paid for 40% of the company. We get 40% of that. We're going to increase our investment account by $72,000, and same thing for the dividend. Right, we're going to reduce it by 40% of the $80,000 in dividends. Reduces our investment account. These are the main journal entries for our equity method. Be familiar with them. Practice. All right, we're still on the same example. Now this is the asset adjustment and depreciation. Now, the fair value of the company in the given information before was $1.2 million. The net book value was $1.1 million. So we are only cared about our percentage of it. We care about the 40% that we purchased. So here you can see the calculation. Here's our portion of the fair value, and here's our portion of the net book value. So the asset adjustment is $40,000. What we are doing is we're essentially writing it up. We're writing up our asset because net book value, it's actually worth more because the fair value, maybe this fair value comes from a valuation team comes in, or maybe it's from just the reflection of the stock price, right? This is a fair value right here, and this is going to calculate that asset adjustment. So we're writing that up. Now, what about goodwill? Goodwill, this concept, right? So this is, let's say a company is trading on, let's just use 100% for an example right now. Let's say I'm a very wealthy individual. I am going to buy a company, 100% of it for $1 million. Now, what if total value on the stock market is only $900,000? Well, I overpaid, and there's many reasons why you'd overpay. I mean, it's just a bullish sign. There's a bunch of reasons, but at the end of the day, it is goodwill. You're showing goodwill by overpaying, and you get $100,000 of goodwill on your balance sheet, right? 1 million minus 900,000 is $100,000. That is goodwill when you overpay for a company. Now, let's say I underpaid. Let's say I paid $900,000 and the value in the stock market was, $1 million. Now, how did I get that for a deal? I mean, it was probably just like a private equity deal, right? We made a deal with the ownership of the company. So we were able to pay less. And this is a bargain purchase, and you would recognize $100,000 of a gain on a bargain purchase, not negative goodwill. There's no such thing as negative goodwill. They will try to trick you and use that as, possible trick answer. Well, as I said, the goodwill is the excess of the purchase price over the fair value of the net assets. So what did we pay? We paid $600. What's the fair value? Well, it's $480. That was our 40% of the fair value, right? So asset adjustment from the purchase price is $120,000. So in this case, we have $120,000 of goodwill because we paid $600. The fair value of what we paid for was only $480. This is our goodwill calculation. So that's another thing you might have to do for your questions that they'll ask. What about depreciation on undervalued equipment? This is less common here, you might see here. But this is basically we needed to depreciate our undervalued equipment. This is an expense, so we're writing down basically our investment subsidiary corporation. So this 636 is taking into account our initial investment plus $72,000 of our share of net income, because that increases our investment in subsidiary, minus 32. And where's that 32? That 32 is the dividend paid by the investee, subtracting out another 4,000. That is from our recording depreciation on undervalued equipment. Total on the balance sheet is going to be 636 for our value of the subsidiary, and then the income statement is going to display 68,000 from our 72 share of net income minus the 4,000 of our depreciation expense, essentially. This is a great example. We're running through goodwill. We're running through all of our equity method examples, what we're going to need to see here.